Welcome to the Capital News and this episode and presentation of Capital Economics, where today we have central banks the world over right now, particularly the major central banks of the Federal Reserve of the United States, the ECB, the European Central Bank, obviously of the Euro area, and the Bank of Japan primarily. Those three banks are meeting this week, or the ECB met last week, but we also have the Bank of England meeting this week. So we have to pay attention to what these central banks are doing. We are in the midst of an economic experiment, a global monetary experiment. How has it been working? Will it be able to continue? If it does continue, what will it look like? And has the actions undertaken by these major central bankers, has it put them in a position where they are now trapped? Does this mean they are going to have to continue with, or perhaps I should say, to begin another easing cycle? That is to say, begin cutting interest rates? Are they going to have to stop any version of quantitative tightening and embark on another round, or rounds plural, of quantitative easing? These are serious questions to ask, because when we look through this presentation, and we're only going to focus on one graph. There's going to be a few data points on this when we're looking at the total assets of the Federal Reserve, the ECB, and the Bank of Japan. But we're only going to focus our attention here on this presentation on one graph because there is enough to look at. Now, for those of you who are followers of my podcast, The Capital News, or are visitors of thecapitalnews.com, our website, know that the podcast and the website pretty much just focuses on commentary, and I don't throw up a whole bunch of charts and graphs on that, but I want to start doing that on the website, on the YouTube channel, and other areas, social media, where we post, because I want this audience to have a better understanding of the data that I'm looking at to present to you the podcast. When I talk about insanity, when I talk about an experiment, this is what we're talking about. So if we're looking here at a chart, and here I just want to let everybody know, for those of you who may not be familiar with FRED, which is the Federal Reserve economic data, Federal Reserve economic data. You can Google this. You can find this very easily. This is free to you. There are tens of thousands, if not hundreds of thousands, of economic and financial variables. Very interesting website. Very helpful. You can slice and dice this data pretty much any way you want to. It's a resource. Use it. Or at least make sure you stay tuned to the Capital News, because going forward, we are going to be focusing on a lot of this data because we have to. So given the fact that central bankers now seem to be leaning more towards an easing cycle as opposed to wait and see, let's just keep it steady, or even tightening, because last year, ladies and gentlemen, it wasn't that long ago, you had major central banks saying, okay, we're going to continue tightening. We're going to continue increasing interest rates. We're going to continue with quantitative tightening. We're done with quantitative easing. We're done with an easing cycle. We are not going back to ZIRP, ZIRP, zero interest rate policy here in the United States. Of course, if you're in Japan or if you're in Europe, you already are dealing with NIRP, NIRP, negative interest rate policy. This is a recipe for disaster, ladies and gentlemen. You can look at this graph, and if you're already ahead of me looking at this, you know that what you're looking at, especially in the latter half of this graph, it's not normal. There is nothing normal about this. There is nothing predictive about this. There is nothing anybody can explain to say, oh yeah, this is rational economic theory. We've seen this and done this before. No, we have not. This is ridiculous, and this is going to have serious negative consequences for the global economy. It's already starting to make its way through the system. It has been for the past 10 years. This is why we have seen slow and stagnant growth throughout the major economies in the world. This is because we have been dealing with manipulation in a flawed system, in a fraudulent system, unfortunately, And this is evidence as far as I'm concerned, as far as my analysis is concerned, here with the Capital News, that these central bankers don't know what they're doing. And I think that is evidenced by this graph. So just to set this up, let's make it real simple, okay? On our y-axis here, we're talking about trillions of dollars, trillions of dollars, trillions of euros, trillions of yen, okay? So if we're looking at the graph and we're looking at this blue line, this is the Bank of Japan. If we're looking at this red line, we're talking about the ECB, the European Central Bank. And if we're talking about this green line here, we're talking about the Federal Reserve. So for those of you who may be followers of the Capital News, know that on a near daily basis, we're talking about central bank policy, we're talking about quantitative easing, we're talking about interest rates, and perhaps we might be talking about quantitative tightening. So if we look here historically on this graph, because on the x-axis, we're talking about time, and we're talking from 1999 to the present day, you have the balance sheets of these banks, and here we're looking at total assets. And you're looking at, in regards to the green line, again, that's the central bank, the Federal Reserve. We're talking about quantitative easing, and we're talking about this shape here. This is what's very important. Pay attention to the shape of this, because as we do other presentations, I want you to be very mindful of this rapid increase, the slope of these lines, which is indicative of the rate of change, which if you're paying attention to any type of financial metric, you have to look at the rate of change. What we're looking at right now are simply the levels, is what they would be called, which just means what the number is today. We're looking at the levels. We're not looking at the rate of change. We're not looking at percentages here. We're looking at the levels, what these numbers actually are, okay? If you look at this step-like pattern here in regards to the Federal Reserve, you have this rise, you have this run, you got another rise, another run, and another big rise, and then you've had this run, this plateauing here for a while, okay? This is indicative. This is, what you are looking at is quantitative easing. So what you've heard me talk about for a long time, you are now seeing right here. So this is quantitative easing. Quantitative easing 1. A little bit of, well, let's see what happens. Didn't do enough. Let's do quantitative easing number 2. Let's see what happens. You got Operation Twist. That didn't really do it. And then boom, you got this big step. You got quantitative easing number 3. And we've sort of been plateauing here for the past few years. 2014 all the way to 2017, because in 2017, you started to see the Federal Reserve say, okay, it's time to go back to normal, whatever that means. And we're going to begin quantitative tightening. And they've been pulling liquidity out of the system for the past year and a half, going on 2 years now, trying to get back to normal. I would presume when they say normal, they would mean back to where we were maybe in quantitative tightening number 2, quantitative easing number 2, quantitative easing number 1. Maybe that's normal to them, but we're not anywhere close to that, folks, because at the peak, you're talking maybe about $4.5 trillion of total assets sitting with the Federal Reserve, and now you've had maybe $50 billion a month at the most, as announced by the Federal Reserve, per month in quantitative tightening, only to take you back maybe around $3.6, $3.8 trillion. I mean, that's nowhere close. I mean, you're still well within QE3 here, okay? So we are not anywhere near normal. None of this post-2009 is anything but normal. I mean, just look at it, okay? You don't have to be an economist. You don't have to be a rocket scientist to figure this out. There is nothing here that is normal. Because if you look back prior to the great financial crisis, and I mean, you could really take this data back out to the beginning of the Federal Reserve back in 1913, and you have this data. It's a flat line. It's a slow, steady increase. And up until, this is the history of the Federal Reserve, up until the great financial crisis, you were below $1 trillion, which you can see is evidenced right here on this graph. But following and during the great financial crisis, you had Ben Bernanke, the then chairman of the Federal Reserve and company, say, oh no, we got to flush the system with liquidity to save the system that's destroyed us, that brought us to our knees. That's the system that they decided to save. And you see this rapid increase. This is almost a 90-degree angle here. This is a huge rate of change. It took the Federal Reserve's entire history, nearly 100-year history, to get to $1 trillion. And now we have been increasing assets in near trillion-dollar increments. And now we're getting to this point here, ladies and gentlemen, where we are today. And that's why this leads to our question. Are central banks trapped? Because the other thing I want to point out to in these graphs is there appears to be coordination between the central banks, at least these major central banks. Now, they might deny this. They may accept it. I don't care, because we are going to be looking not just at what they say, but what they do. And here's the action. Here's the data. Here's what happened. So in the midst of the great financial crisis, you had both the Federal Reserve, here the green line again, and the red line, the ECB, both rapidly begin their quantitative easing projects, their experiment. Okay? And they said, okay, let's do this. Let's take a breather now and let's see what happens. Well, it caused a calming. This calmed the markets. Okay, the Federal Reserve, central bankers, they're getting together. They're saying we can contain this now. We can reflate. I'm sure you've heard the word before. We can reflate financial assets, stocks, bonds, the like. And then there could be perhaps a wealth effect from this. We can reflate these asset prices because there were huge market sell-offs during the great financial crisis, 50% declines. We need to reflate them. And this can result in a wealth effect. Thereby the people who own financial assets, who are predominantly the upper echelons of the income brackets, they will be reflated, these financial assets, and then that money from these individuals will spend that money in the economy, and you will have this wealth effect that will trickle down throughout the broader economy. Of course, this is a bunch of nonsense. This does not happen, but it still is a major contributor to the income inequality that we see the world over, which has given rise and root to political populism the world over. In the United States, with the election of Donald Trump, you now have Boris Johnson as the Prime Minister of the UK. You have populist countries in Italy now in control. You had the Yellow Vests riots and protests in France. This is the world over. The world over. We just had big riots in Hong Kong, but I digress. This is the interconnectedness of society, politics, and economics. There are real consequences to these types of actions, okay? So you had this in tandem movement of a huge increase in liquidity to reflate financial assets. You then saw, okay, let's see what happens over the course of a couple years. Let's see what happens. And the United States said, all right, this isn't good enough. We need to prime the pumps once again, and you had QE2. Then, in 2011, 2012, you had the problem with the pigs nation in Europe. Remember those? Portugal, Ireland, Italy, Greece, and Spain, which are still front and center right now. They're coming back. Sometimes they're on the front burner, sometimes they're on the back burner, but they've never gone away. And believe you me, we will be talking about these countries and others, probably Germany in the mix as well, in the not too distant future. But Europe started to have a problem. And so the ECB said, all right, we got to go back to our version of quantitative easing, and we got to prime our pumps. And you can see how drastic a measure this was in the duration and the rate of change, which you can see, which is evidenced by this slope, okay, with the ECB. Then they peaked. They said, okay, maybe we have things under control. The Federal Reserve is here. Again, we're talking about coordination or seemingly coordination between central banks the world over. And you see the ECB come down. The Federal Reserve says, okay, you can go down. We'll pick it up. We'll pick it up with a huge amount of quantitative easing, QE3. Then the ECB comes down. They hit their bottom here. This is, I guess, they were trying to return to normal, but it has not worked. You have zombie banks and companies littering Europe. We talk about it all the time on the Capital News podcast. But lo and behold, to pick up the slack, you had this. You had QE3, and now you have the Bank of Japan, who was sort of just lying dormant for several years following the great financial crisis. Now they're coming in. Now they're priming the pump. They've been dealing with stagnation for 30 years. They've been dealing with extremely low inflation, if you want to believe them, for years. But they said, all right, Europe, you're going to slow down. We're going to pick up the slack with the United States. Now, you had, presumably, we've hit a limit. This is completely arbitrary, by the way, ladies and gentlemen. There is no economic model, there is no economic textbook that would tell the Federal Reserve, you guys got to stop at about $4.5 trillion of a balance sheet. No. This is completely arbitrary. They are shooting from the hip, ladies and gentlemen. None of this after the great financial crisis is normal. Okay? Which again leads us to our question, are central banks trapped? Because you had the Federal Reserve plateau, and to pick up the slack for this plateauing effect, you had the Bank of Japan come, and they continued to prime the pump. And in this plateauing effect for the Federal Reserve, you also had the ECB come here and continue to prime the pump. But now, you are seeing the Bank of Japan starting to roll over. Are they going to plateau? You're seeing the ECB starting to roll over. Are they going to plateau? And for the past couple of years, you've seen quantitative tightening here in the Federal Reserve. At the end of 2018, we saw a huge market sell-off in global stocks. 20% here in the United States, some indices even worse, some markets even worse. Is this because interest rates were going up? Is this because there was quantitative tightening? Is this because you are seeing this rollover and plateauing effect in the ECB? In this rollover and perhaps plateauing effect in the Bank of Japan? Are markets completely manipulated and or dependent on central bank actions? That is the question. And if central banks are going to be concerning themselves with financial assets more than their mandates of inflation targeting or with the Federal Reserve, full employment and stable prices, if they're more concerned with stock markets, if they're more concerned with financial assets, then it appears that they've trapped themselves. Because the question that is most pressing right now is, how are these central banks going to respond? What are these graphs going to look like as we make our way throughout 2019, 2020, and beyond? Because again, there is nothing normal, ladies and gentlemen, about what has been taking place from 2009 onward. I mean, just look at these graphs. Do these look sustainable to you? So now the question becomes, if we're looking at the Federal Reserve graph, is quantitative tightening going to continue? Or is it going to plateau? Or are we going to have another round of QE, quantitative easing, and we start to shoot up? Is that going to be what happens? What about the ECB? Is it going to continue with this plateauing effect, or is it going to shoot up? What about the BOJ? Is it going to plateau, or is it going to spike up again? These are serious questions, and I am telling you, folks, this has serious ramifications for the broader economy at large, for society at large, and for financial markets. If you follow me on the Capital News podcast, you know I talk about all the time the diminishing marginal returns, which simply just means there's less bang for the buck as we make our way further and further down. You see this QE3? Look how much bigger it had to be than QE1 and QE2 to sort of get the same type of effect, the same punch that QE1, QE2, and Operation Twist did. And for what purpose? To simply reflate and inflate asset prices. But at what expense and what cost? Because if you have individuals and corporations and governments moving further and further out onto the risk curve, which again we talk about all the time on the Capital News, that debt, that credit is going to come home to roost. You're going to have to pay the piper. Are these central bankers, are they going to continue to prime the pump? We have the Federal Reserve meeting this very week. We had the ECB meet last week. The Bank of Japan is meeting this week. The Bank of England is meeting this week. Are they going to begin another easing cycle? Because we've been in wait-and-see mode for quite a while. These are serious questions to ponder, because as we make our way through other presentations, we're going to be looking at other economic data and financial data that says when central banks begin another easing cycle, it's not good. It tends to portend an oncoming recession, which we talk about here all the time. If we're looking at these financial data pieces, if we're looking at a whole bunch of economic data, we're trying to put all these pieces together to paint an economic picture. What does that economic puzzle look like? What is it telling us? How do we have to prepare ourselves? So with that, I'm going to conclude this presentation of Capital Economics. Pay attention. Are central bankers trapped? We think they are. They're not going to come out and tell us the truth. They're not going to come out and say, we messed up, that this is some grand experiment that just simply isn't working out anymore, that we have to get back to some semblance of normal. We're not anywhere near normal, which is evidenced by this graph. So I please implore you to take the time, look at this data for yourself, put other charts, put other data points on here as well, and educate yourself and educate others. It's very important that we do so. So I want to thank you for your time. Please like, share, and subscribe to the Capital News. Check out our website, thecapitalnews.com. Be sure to like, share, and subscribe if you're on YouTube, if you're on iTunes listening, or if you're on Twitter, wherever you're finding it. It's a great support. It really helps out the channel and our website, and we want to get as many followers as possible because this stuff is very important. Also, another way to support us here at the Capital News is to go on Amazon.com or BarnesandNoble.com and check out our book, The Cynic's Guide to Investing. If you want a greater synopsis and better understanding of the economy at large, fiscal policy, monetary policy, understanding trends and demographics, and then tying it all together with investment strategies and evaluations. Again, you can find The Cynic's Guide to Investing paperback, hardback, or electronic version on Amazon.com and BarnesandNoble.com. So thank you again, ladies and gentlemen. Stay diversified, stay vigilant, and stay with the Capital News. Thank you.